Good morning, ladies and gentlemen. Welcome to Sansera Engineering Limited Q2 FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve the risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. B.R. Preetham, Group CEO, Sansera Engineering Limited. Thank you, and over to you, sir.
Thank you. Good morning and season greetings to everyone. Welcome and thanks for joining this call. On this call, I'm joined by our CFO, Mr. Vikas Goyal, our COO, Mr. Praveen Chauhan, and our Investor Relation Advisor team, SGA. The results and the presentations are uploaded on the stock exchange and the company website. I hope everybody has had a chance to look at it. I am delighted to update that this quarter we have crossed our highest ever quarterly sales, building on various momentum in the domestic market. Over the years, diversified product portfolio, customers and markets have been our strong suit, and this has helped us to deliver a healthy performance once again. Our customers continue to appreciate our efforts, and we have been recently awarded for excellent supplier performance from Boeing, one of our key customers in the aerospace segment. We have also received awards for zero defect supplies from both Toyota Kirloskar Auto Parts and Toyota Kirloskar Motor as well. Talking about some major business wins, we have recently won an order from a global OEM with a peak annual revenue of 1,300 million rupees. This contract would be for a time horizon of around 6 years, starting from 2025. We have also secured a 6-year order from a well-known American company in the auto space with a peak annual revenue of 250 million order. This is in the non-auto space. Our order wins for connecting rods from Tata Motors and Ford Motors and also Volvo Eicher are progressing well. In fact, the mass production has commenced in this quarter. And we are engaging with them on various other products as well. Before we dive into our performance during the quarter, I would like to take a moment to speak about EV industry in India and Sansera's progress therein. Currently, the overall industry is still at a very nascent stage and it is developing at a very rapid pace. EV penetration in India, as per various surveys, are just about 2.6% of the total automotive market. And our government of India is targeting between 30-35% of EV penetration by 2030. As we have mentioned in our previous call, Sansera has already secured business from traditional OEMs and new age startups in the EV two-wheeler space. Today we have 12 XEV customers in all the sectors, including some marquee global names. Our wealth of experience in ICE provides us with a solid foundation to grow in the EV space. Interestingly, in the two-wheeler scooter space, today Sansera has 6 customers for tech-agnostic and XEV components, vis-a-vis 4 customers in the traditional ICE components. Also, our peak content per vehicle for auto tech-agnostic and XEV components in an EV scooter is about 1827 versus rupees 1467 in a traditional ICE scooter. Production lines for two-wheeler, XEV and hybrid PVs at our dedicated facility for hybrid and electric components began mass production in Q4 of FY22. and it is ramping up well. Our EV business is growing from strength to strength with the addition of new customers. This quarter, close to 3% of our total sales came from XEV segment. Though still small, it gives a fair sense of our progress directionally. A couple of our customers in EV two-wheeler space are getting us prepared for mass production. As a result, we are anticipating accelerated growth of our components in the coming quarters. We have already doubled our revenues from XEV and tech-agnostic segments in H1 FY23, and we expect this trend to continue in FY23. Coming to our performance, we registered a year-on-year growth of 17% in revenues to achieve a total revenue of 6,362 million rupees with an EBITDA margin of 17%. Our CFO Vikas Goel will talk about this in detail in a bit later. Sales of our auto segment soared by 20% year-on-year, largely driven by growth in domestic markets. This segment contributed around 90% of sales in Q2 FY23. Of this, 10% of sales came from auto tech agnostic and XEV products versus 7% in the last Q2 of the last financial year. In terms of Q2 FY23 sales mix for auto segment covering both ICE as well as XEV and tech agnostic components, 39% sales came from motorcycle segment. Scooter accounted for 15% of our top line. China Plus policy of some of our customers, where we had secured big business in the past, has now started maturing into full volume. Also, a couple of our customers are transitioning into the new engine and are relying more upon outsourced partners, leading to a higher share of business with them. So a combination of these two factors resulted in a robust two-wheeler growth for us. Passenger vehicle accounted for 27% of our top line. Commercial vehicles accounted for 9% of our top line. Given that a significant portion of the sales of CV comes from our Swedish subsidiary, we witnessed a subdued performance in Europe in this quarter. Our non-automotive segment contributed 10% of the sales in the quarter in our current sales mix. Aerospace contributed to about 4% of our sales, registering a strong growth of 41% year-on-year in the quarter. We expect this momentum to continue and register a 35 to 40% growth in aerospace revenues this year. Agriculture segment accounted for about 4% of the top line. Off-road sectors registered a substantial reduction, largely owing to the continued supply chain challenges faced by the customers. Sales contribution of the off-road sector came down from 4% in the Q2 FY22 to about less than 1% in Q2 FY23. And we expect that this would be on the recovery path from the Q4 23 onwards. And the remaining 1% of the top line came from a few other segments. On the capex front, our new aerospace and defense facility is almost ready and is expected to get into the operations by the fourth quarter. The mass production, post all the approvals, is expected to start from the year FY24. Coming to our order pipeline, as on 30th September 22, our order book of the new business with an annual peak revenue stood at 14.2 billion rupees, with auto ICE contributing of 6.94 billion, 49%, and auto tech agnostic adding 4.41 billion, amounting to 31%. Non-auto accounts for 2.84 billion, and which contributes 20% to the sales order pipeline. This order book continues to showcase the progress that we are making towards our long-term vision of improving market share, participating in XEV opportunity, and diversifying into technology agnostic components. and focus on non-auto sectors. Our aluminum forged and machine components continue to see a very healthy traction. Going forward, our growth will come on both auto and non-auto sectors. With a strong festive season, automakers reported a very healthy domestic demand, and we expect the recovery to continue in the coming times. However, exports may continue to be a drag for the industry this year. So going forward, we expect our domestic sales to register higher growth. In addition, our growth will be driven by new products like xEV and hybrid components, for which mass production has already started. On the non-auto side, we should see a strong uptick in aerospace and defense business next year. The last 2-3 years were rather dull for the sector, but now the demand has come back strongly. Now I hand over to our CFO, Mr. Vikas Goyal, to talk about our financial highlights.
Thank you, Preetham. Good morning, everyone. I would like to cover the performance during second quarter first. Our revenue for the quarter stood at 6,362 million as against 5,418 million last year, which is a growth of 17% on a year-on-year basis. This growth is a combination of superb sales growth in our domestic sales, which was partially neutralized by underperformance in the international sales. In fact, I'm delighted that we recorded our highest ever quarterly and half-yearly sales in the review period. In the quarter gone by, we were able to pass on the commodity price increase to our domestic customers. This increase was retrospective for 2 quarters. However, the passing of cost makes the margin percentage appear narrower in an optical sense. Further, the reduction in international business both sequentially and on a year-on-year basis also impacted the gross margins negatively. Our expenses increased by 17% in line with the revenue growth. With the higher COGS percentage, our EBITDA margin for the second quarter stood at 17.1% against 20.1% in the second quarter. We'll talk about it in more detail in the H1 summary. Finance costs for the quarter increased to 144 million as compared to 113 million in the corresponding quarter in FY22. This increase was largely due to the higher working capital borrowings to support the business growth and also the interest rate hikes that we've been witnessing in the recent times. Profit after tax of rupees 469 million in second quarter as against 518 million for the last year same period. The geographical sales mix of Q2 FY23 stood at as follows. India accounted for 77%, Europe 16%, US-based customers 4%, and other foreign countries about 3% as a percentage of total product sales. Exports have been muted in this quarter, and we expect this trend to start improving by fourth quarter from this year based on our current visibility. Now, talking about the half-yearly results, looking at the half-year numbers, the total revenue surged by 25% on a year-on-year basis to 11,691 million as compared to the corresponding period last year. This includes approximately 3.5% of the material inflation passed on to the customers in domestic region. For H1 FY23, EBITDA stood at rupees 2,008 million with a margin of 17.2%. The net profit for H1 FY23 stood at 817 million and registered a growth of 16% as compared to 706 million in the corresponding period in the previous year. Coming to the cash flow and balance sheet for H1 23, the company generated a cash from operations of about 1,299 million against rupees 709 million last year, posting a significant growth in the cash generation. In H1 23, we invested about 1,282 million against the purchase of property, plant and equipment to support the current order book for new business. On debt front, our net debt stood at rupees 6,250 million. The net debt to equity ratio was 0.56 against 0.57 for the year FY22. With this, we would like to conclude our presentation and open the floor for question and answers. Thank you.
Thank you.
Thank you. Thank you. Ladies and gentlemen, to begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Question is on the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi, thanks. Am I audible?
Yeah.
Yeah. So a couple of questions from my side. Firstly, with respect to exports, we indicated recovery from fourth quarter. So what are the indicators are we looking at which gives us comfort of recovery coming from fourth quarter?
Look, we have been interacting with our customers. See, most of our customers do indicate that the supply chain challenges that they had so the result of that was cutting in schedule and correcting the inventories wherever they had built up. And the indications that we get are that from our fourth quarter, which is their first quarter, things would become more normal once they, correct their inventories and start consuming the material. So we expect both in our non-auto, that is off-highway vehicle category, where as I said in my speech, that compared to last year, which was 4%, has come down to less than 1%, and also on the PV sector, this should normalize from our fourth quarter.
Okay. And secondly, on the exports continuing, based on the order book which we have today, in next 2 to 3 years, what percentage of our revenues we expect to be from exports, as against say 37% in FY22? Do you expect that mix to sustain, or that will increase in favor of exports? And within that, do you see share of US going up vis-a-vis Europe over next 2 to 3 years?
Yes, if you look at our order book as well as our current order positions, which the production has already begun, except for this year, when right from the beginning of the year we have clearly said that this year would be a subdued exports. We did not expect any growth in this, but going forward, our expectation is as the things become normalized, we should be back to between 35 and 38% of international revenue on our overall gross sales. So it could be that quarter on quarter there could be some variation, but we expect that overall it would be between 35 and 38% of our revenues should come from our international market. When I say international market, this would include our sales from Sweden as well, and also our exports from India. So we do not expect any big change in that mix, because our current order book also indicates the same thing. And to answer to your second question, how our US order book is looking, or our US sales are looking, US continues to be a very focused market for us. We are adding a lot of business in US. For example, the order win that we have mentioned about in this presentation, which is about 130 crores worth of order annually, for six years from a global OEM, starting from 2025, will amount to almost 700 crores over the business period. And the second order also is from a North American customer in the non-auto segment. Again, we have also been working on a lot of XEV components for a marquee customer. So our US business is looking very, very strong.
Got it. And second question with respect to the euro depreciation against INR. So what was the impact of that in 2Q? Maybe if you can share the euro INR realization for the quarter vis-a-vis first quarter.
Yeah, Vikas?
So we have a rather balanced mix of our trade in terms of euro. We import a lot of materials in euro currency, while we also export. So the approximately 40% of our exports is in euro and 60% happens in dollar currency. And against that 40%, almost, if I look at an overall basis, the ratio within the euro is about 75-25. 75% of that is imports. So net impact on euro appreciation or depreciation is rather marginal at this point in time. While we have a significant headroom in the dollar, which actually is a good news going forward.
Okay. So what was our USD INR realization for the quarter?
You mean the forex
average realization?
Forex gain loss. What was the overall impact? Is that what the question is?
Yeah, and if you can share the forex realization as well on USD INR basis.
So in terms of overall gain or loss, we had kind of a neutral. We incurred a mark-to-market loss of about 6 million rupees because of the forward contracts that we had in place. But in terms of average realization, I can share with you. Give me some time. I'll share it with you.
Sure. And last question on RM cost inflation. So would it be fair to say 2Q was probably the last quarter of inflationary pressures, and 3Q onwards, do you expect some relief or savings on RM costs, which would be having a mathematical impact, positive impact on margins?
No, while the second quarter saw some cooling down of raw material prices, but in our results, all the effect of raw material increase, which was due in the first quarter and later on, which got slightly rolled back in the second quarter, has all come in Q2. So in Q3, that definitely will improve because Q3 will be for only Q3's the thing. But I expect that in Q3, the operational leverage will not be substantial because as the Q3, there would be, Q3 quarter will not be as strong as Q2 in terms of domestic volumes. There will be year-end model change will come in December where the almost 1 week of maintenance off will be there with a lot of customers. So Q3 will be in terms of leverage. So we expect that our margin will continue to be in this range between 17 to 20 and more towards 17.5% in this Q3. But Q4, we expect a good improvement in margins. Definitely, the operational leverage will also kick in, and also there will be recovery from exports.
Sure. Thanks. I'll call that. Thank you.
Thank you.
Thank you. The next question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. Good morning. Thank you for taking my question. So we had a very strong start of orders, new orders this first half. Can you talk more about the new platforms where you're bidding, both in Europe and US? Also in context of, do you see the new platforms which are coming for bid are getting delayed? And also the size of these potential orders, if you can throw some light on these.
Morning, Nitin. Is this the question pertaining to overall platforms or only ICE or it is XEV? So can I understand it the same?
Yes, sir. So first is on the export side, basically US and Europe, across the categories, so across the segments, whether it's ICE, whether it's electric, whether it's aluminium forging specifically. So first on the exports, if you can talk about whether you're seeing some delay in the new orders, what are the potentials of the new orders which you are bidding? Because first half has been very strong, when eventually people are talking about slowness coming in going forward. So that's I wanted to know.
Yeah. So the new orders that we are participating are all generally orders which are going to be executed for the new platforms from calendar year 25, 26, 27. So a lot of these orders that we are participating and we are winning also corresponds to that. So this also goes in line with what we have been maintaining, that more and more outsourcing is being looked at for the new platforms. So the recent win that what we have mentioned in our presentation as well is from a global OEM for a North American operation, and this is we have been working on this project from almost now close to 1.5 years. The product has been tested, various stages of proto has already gone through. So this production would begin in 24, but the relatively the volumes will start picking from 25. And the second order that I also mentioned is on stationary engine platform, and this is starting first in Europe. This is a North American based customer, but the order is starting in calendar year 25 in Europe. But very interestingly, this order would be, we have almost 10x potential on this order from North American base. So what we are looking at, we have also been participating in many more such RFQs where there is a good amount of progress. We are quite confident that the volume of such orders will keep coming. But what I need to also mention here that this is not only restricted to ICE, whether it is in passenger vehicle, commercial vehicle, or in stationary engine category, but on XEV front as well, there's a lot of traction. And in this specifically, what I need to mention is this would not be dependent on model year, because we are participating in both current programs as well as the newer upcoming programs. So we have been given opportunity to participate in both, and I am quite happy to share that while we have last time I had mentioned that we have received certain RFQs, certain orders from this marquee customer. There is a good amount of progress. Our development is going well. We have already developed 4 of these components, and the customer has had several visits to us, and this business is progressing well. While I say that this is on a midterm to long-term view, but what we look at it as I mentioned, we expect that our Q4 and calendar year Q1 of the next year, we expect that there would be a volume recovery, because most of the inventories with our customers have already been corrected or are in the process of getting corrected.
That's helpful, Preetham. Thanks for that. The second question is, you talked about a non-auto, which is keeping a run rate of 50 crore, 57 crore quarterly run rate revenue. And aerospace has doubled almost in last 1 or 2 quarters. So this off-road impact, the category which was 20 crores coming to 2 crores, will that get normalized by next quarter? The question is that if that would have been normalized, you would have been doing 78-80 crore in this quarter out of that. So can you throw some light because how the revenue ramp up should happen in that?
Yes, Nitin, see, basically, I think the customer whom when we have interacted, they had a lot of dependence on China for sourcing a lot of critical electronic and other components from there, which they had a lot of issues in sourcing, so they had to cut their production. There's a very, very healthy order book for them, but they were not able to fulfill those order books. So as I understand that now things are becoming much more better and clearer, and in anticipation of good sales, they had also built up the inventory on other components which they have normalized. So I expect that because we have also added components in that sector to that customer, we had expected, in fact, very good growth for that customer this year, but for this factor. So I expect that this would be back on track from quarter 4.
That's helpful. And lastly, Preetham, we talked about putting up a plant in US for a customer, and then we lost one. The order got reversed, and I think last call you said we still want to put it. Can you throw some light, because is it something for a very specific customer we are going, and we are, hoping that the big order will come, and that will be the catalyst for putting up the plant, or we are still going ahead and putting up the plant now? If you can throw some light on that decision.
Yeah, Nitin, while I had clearly specified in the previous calls and during the topic of this discussion also that while our interest in US plants is for a very big opportunity that exists in both auto and non-auto market and XEV market in US. So, and their policy towards China plus and moving away is wanting them to be closer to their own geography.
Right.
Is the main driving force for us to look at the US facility. While this order which got cancelled apparently had a accelerating effect on this. So because now this order was because this specific order was everything had to be done in the US, while our strategy was on other components, we would do most of the green machining and forging in India and do finishing operations and assembly operations in the US to keep the supply chain lean. So this strategy we continue to have because our focus on US is continuing. Our growth in US in both auto, non-auto as well as XEV continues. So we are quite keen on setting up a manufacturing facility. But the time frame, we have no constraints like the earlier this thing. So in fact, we had a detailed visit to US last month. I was to look at various potential sites and talk to various customers about their upcoming programs and this thing. So our plans are very much intact of starting. Only the time frame is when we need to decide. So at an appropriate time, we will take the decision. But the plans are being done for having a facility in US.
Thank you, Preetham. It's always a pleasure talking to you. Thank you.
Thank you, Nitin. It's always our pleasure too.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Basudev Banerjee from ICICI Securities. Please go ahead.
Yeah, thanks for a few questions.
One, Mr. Banerjee, so we are not able to hear you clearly. Can you use the handset mode while speaking?
Audible?
Much better, sir. Please proceed. Thank you.
Yeah, thanks. A few questions. One, sir, as per your presentation, 4% of revenue is from aerospace in first half, so which means roughly 50 crore. Am I right, sir?
Pardon me. Can you just be louder, Basu?
Sir, as per your presentation, aerospace revenue is roughly 4% mix in first half, and first half revenue is roughly 1,200 crores. So roughly 48-50 crore revenue was from aerospace.
Yes, very close to that. 40,
Yeah.
It was 40. Yeah.
The percentages that we indicate here are with respect to product sales.
Yeah.
Yeah.
So just wanted to know, last few quarters back, we were discussing about post-COVID aerospace revenue moving back towards 200 crore. So what's the situation with regards to that, and what's your outlook in terms of timeline to reach such an annualized run rate?
Basu, yes, we would definitely, the plans for reaching aerospace to 200 crores is very much intact, and that is where our progress has also been there. This year, the recovery of aerospace sector is quite good. We expect that we would be doing better than H1 in H2. Our order book also indicates the same thing. And with the new plant opening up in this, starting production in the next financial year, we do expect that we will be reaching or will be doing better in at least, our target was in 3 years time frame we should reach 200 crores. So we would be still, the target is still there, and we are hopeful that we should be doing better than that.
Sure. So roughly 3 years means including 23, you mean, or from 24?
No, including, 24, 25, 26. So the 3 years is what.
Okay, understood.
Yeah.
Second thing, sir, as you mentioned in the earlier part of call, 38% of Concall revenue to be out of India, including Sweden CV parts business. So, if you can mention the health of the Swedish business now and your outlook for next couple of quarters, margin situation there.
Yeah, like last time also, I had mentioned that this year our Sweden sales will be subdued because of the change in strategy from our OEM, a major OEM, where we were 100% in certain category of components, and then there was another source which were 100%. So they wanted both of us to be 70%. So that transition is going on. And added to that, the energy crisis had put some pressure. But we expect that in the coming year, the Sweden growth will be back to normal revenues of like the previous years. Though we do not expect too much of change in volumes, but operating efficiency by increasing automation and increasing engineering efforts from India, we expect that we will maintain a healthy double-digit EBITDA from Swedish facility from next year. This year, as mentioned in the earlier reports also, we will have a degrowth, and this would be only a temporary year in terms of Europe revenue. I mean, in terms of Swedish revenue.
And how much was the EBITDA in first half, sir, if I missed out?
For the Swedish facility, you mean?
Yeah.
About 7%.
About 7%.
Okay. So basically, the today's margin of 16.7 includes that deterioration of European margin. So its revival should also help. And third question, sir, as in your earlier discussion also, you mentioned that in 3Q, operating leverage will be at a disadvantageous position, though Q1 it was an after effect of cost pass on of 1Q and 2Q together. So the outlook should be Q3 margin remaining static with gross margin improving and other costs as a percentage of sales moving up. So if you can help us understand in this 400 bps of gross margin deterioration, how much was because of 2 quarters piled up together?
Yeah. So, Basu, I think for better understandability, I would suggest that because Q2 was slightly skewed, all the raw material effect got accounted for in Q2. So if you look at H1, that would be probably a better thing. So Vikas could probably give more meaningful, breakdown of that. Vikas?
Yeah. So Basu, in terms of if you look at H1 results, about 1.9% is the margin deterioration on account of material inflation and the geographic sales mix combined. There is a slight increase in manufacturing expense, which is also responsible for that, about 0.2%. And we expect this to be kind of a run rate going forward. So if the material cost remains same, so instead of 4%, right? Then we had the operating leverage on employee cost and other expenses put together about 0.6%, which should partially offset during the third quarter because of the subdued volumes, because of the cyclical nature of the industry. All of these should improve on the recovery of exports during fourth quarter, as well as on the operating leverage getting better because of volume expansion in the fourth quarter. So we expect to hold our margins or EBITDA margins in the third quarter and achieve an uptake during the fourth quarter because of improvement of all these factors.
And so if I missed out, you explained this 1.9%, how much time will it take for the full reversal of that?
It's already been So it's not a reversal. It's a optical effect of material content becoming higher in the overall value.
Understood.
So, Basu, in that 1.9%, about 1.3% is the optical impact of raw material. About 0.4% was the effect of change in geographical mix. If you please see that, almost 25% is the on quarter, 25% is the erosion of exports compared to the last Q2 of last year to Q2 of this year. So this 0.4% as the exports become better will come back definitely on margins. And this 1.3%, which is the raw material impact optically, will continue to be there for some more time till the raw material prices gets corrected.
Understood. And last question, if I can chip in. October retails and wholesales of two-wheeler EVs saw a good spike up. So as you are supplying to multiple OEMs, how is the production schedule outlook looking ahead for next few months? Is that spike up sustainable or moving up further, or you see some normalization?
So overall, we see that two-wheeler industry is doing better than what was expected. Especially, there is a lot of stability coming in from some of the new age electric vehicle startups where there are a lot of issues. So we see that there is a good steady thing. One of our key customers, HMSI, have also been doing pretty well. So there are some of the customers who still are struggling, but overall we see that two-wheeler industry is doing better than what we had expected. So the order position overall, if you look at it from all the customers put together, looks better.
And any color on two-wheeler EVs specifically?
Yes, two-wheeler EVs, in fact, continues to do well. Our participation has also increased. We now have 6 customers. The volumes have started going up. That is the reason that you see that we've already started registering a noticeable portion of our revenues that's coming from EVs now. 3% of our revenue started coming from EVs, which is small, but directionally what we want to achieve, we are very clear on that. Even the order book also indicates that almost 20% of our order book we have XEV components specifically. So we are quite bullish on performance of XEV two-wheelers for the coming quarters as well.
Sure, sir. Thanks, all the best.
Thank you, Basu.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, we request to limit your questions to 2 per participant only. The next question is from the line of Siddhartha from Nomura. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. Sir, my first question is on the order book. So we have shared that the orders book has gone up from 11 to 14. Now you have shared 1.3 from this 1.5 from the 2 customers. What about the rest, sir? How have those have got added?
You mean there has been order inflow from all the sectors. There have been order inflows from quite a good number of aluminium orders we have been able to get. In fact, there is substantial increase in that too. If I am not the thing that almost 100 crores of orders have been booked on aluminium components as well itself. So we have been seeing, we have got received orders from aerospace sector. Defense is shaping up well. So there is a good amount of order inflow from all the sectors.
Siddharth, quite interestingly, if you look at the order book, 18% of this order book is coming out of XEVs only. And that's the most interesting part. And that's in line with what we had been talking about directionally. And that all makes us quite comfortable that indicated 40% plus coming out of non-auto ICE, non-auto tech agnostic and EV. I think we are very well on track, rather we might exceed that.
Got it. Got it. No, sir, this aluminum component orders which you talked about, these are for which sector broadly? Will it be more for aerospace or it's across components?
No. These what I spoke about specifically is about currently on two-wheelers.
Okay, more for two-wheelers.
Yes.
Okay. And second is on this ramp up for the second half. Can you just sort of guide us in terms of pickup, in terms of orders execution? What all things we should expect to come through in the second half of the year?
See, some of these XEV customers with whom we have been working on, the mass production is commenced and the ramp up will happen on that, on the two-wheeler front. We have already started commenced production. I am very happy to say that Tata Motors we have added them as our customers. We are very, very happy and proud to be that. The production of that has started. There is a very positive feedback from the customers on that. We have added Force Motors. The production has started for that. We've added Volvo Eicher. The production again has started for that. There has been an increase in these are all sectors where we were not very strong, and be it agri, be it commercial vehicle in India, all these are sectors where our presence was not very strong, and we have been able to penetrate this, and the production has started. Hybrid components for our customer has already started, and it is at a full ramp up now. There is a braking system components which goes to European sector where the ramp up full mass production has started, which will also contribute to this revenue. So these are all some of the, of course, as I said that aerospace and defense continues to recover, and new orders are also being executed. So all these things should, give us that required push into the the next level of revenue growth.
Got it, sir. Second question is on the exports, which you have already touched upon. So just some clarification. So earlier you had said exports is likely to be flattish for the year. Now, if we see for the first half, they are down about 15% on a YOY basis, trending at about 100 crores in the quarter. So now, if we look at from the next couple of quarters, first is, do you still maintain that earlier guidance of about flat for the year, and that implies that we should be somewhere back to the earlier levels or slightly higher than the earlier levels in the second half? Would it be right way to think about it?
I still think that more or less we should be in that range itself, because I expect that the quarter 4 to be relatively strong for exports. So my expectation is that we should be more or less very, very similar to the last year numbers.
Got it. Okay, sir. Thanks a lot. I will come back in the queue.
Thank you, Mr. Stat.
Thank you. The next question is from the line of Ankit Kanodia from Smart Sync Services. Please go ahead.
Audible? Hello?
Yes, Mr. Kanodia.
Yeah. Thank you. Thank you for taking my question. In your presentation slide number 23, we have given the sales mix in 4 aspects. One is in terms of geography, one in terms of customer, one is in terms of product mix, and then one is in terms of customer relationship. I just had a longer term, I wanted to have a longer term view from your side as to how do you see all these 4 parameters going in, say, next 2 to 3 years? Directionally, I know you can't pinpoint a particular number, but if you can give some color on all these 4 aspects, that would really help. Thank you.
So, thank you. Geographically, I've already made it clear for the next 2-3 years, we expect that not going to be a very big change. We expect about 35-65 broadly of our geographical mix between international revenue and Indian revenue. In terms of customers, as we keep expanding our sectors and adding new customers, I expect that in the next 2-3 years, none of our customers would be more than 10%. So while we grow with each of these customers, but relatively the other growth is much higher, so which would mean that our dependency on one customer would keep coming down. So I expect that the biggest of our customers could be very close to a double digit, not more than that. In terms of products, as I said that, overall, if you look at it, our target is by next 3 to 4 years, we should reach that 40% of our revenue should come from non-auto and tech agnostics. It could be 25-15 or it could be 20-20, but we have said that overall as a basket, 40% of our revenue should come from non-auto and tech agnostic components, and I am quite confident the way our order book is shaping up. We would still be doing better in terms of if the XEV offtake improves, then this ratio will be much better. In terms of our relationship with the customer, as we strengthen our existing relationship with our customers, we are also adding a lot of customers, and that is one of our focus that while we keep adding our new customers, we would not lose our focus on our existing customers. So we keep working tirelessly to make sure that our existing customers keep giving better share of business and add more products. So I expect that while we focus on the newer technologies, our bread and butter components, specifically connecting rod for passenger vehicle and commercial vehicle segment internationally, it's our target that overall we should reach on a medium term about 10% of global share of business, and we are working very tirelessly towards achieving that. So these are fundamentally, how we are looking.
Thank you. Thank you so much, sir, for the detailed answer. Just a follow-up on that. If we broadly assume that domestic and export market percentage would be broadly similar, so is it fair to assume that the EBITDA margin will also be on a similar range, or do we have other levers through which we will see an uptick in margin going ahead?
We expect that with better utilization, we have always maintained that our EBITDA margin should be between 17 and 20% is what we say. And as our utilization and recovery in the two-wheeler sector happens, we should be towards the better half of that range. So that is what we expect.
Thank you, sir. And any particular long-term risk or any particular point which you will be most particular about when you think of realizing these all long-term goals of sales target?
As you keep accelerating the growth, there are always challenges that the company face, and it's nothing different to us also. We also go through the same thing. While we cater to large inflow of RFQs and large inflow of orders that are getting executed, there is a stress on the entire human, all the manpower that we have, especially on engineering. So we have been working on, I've mentioned this in my previous call also, that we have been working on processes and systems as to how to better this thing, because as the customer expectation, the product life cycles are coming down, development times are coming down, the customer expectations also become steeply increasing. So with all these things in mind, we have been working on adding. So that could be one of the challenges as to how effectively we can manage our engineering resources to cater to this increasing demand. As we diversify into different products and different sectors, these challenges become more amplified. So company is very well aware of it, and we have put a structure in place. We are trying to mitigate that risk by working on succession, working on skill development of our various levels. I'm quite confident of coming through it.
Sir, one last question. Thank you so much for answering everything in detail. Just one last question on competition. How do you look at competition in this space, and how are we positioned towards that? If you could give some comment.
So competition is definitely going to be there. We are quite aware of this fact because as the market is progressing towards EV, especially in EV segment, there is price pressure, there is competition because the addressable space is also limited. So Sansera, with its fully integrated facilities where we offer, the entire solution from design, testing, forging, machining, heat treatment, special process as one-stop solution to our customers. This gives us a slight leverage over the competition. We are quite aware of it that we need to both domestically and internationally compete with very, very, competent companies who are equally competitive in terms of engineering abilities and cost competitiveness. So Sansera we are also preparing ourselves as we try to be more, engineering focused and more new technology focused. So we hope to keep outperforming our competition.
Thank you so much, sir. That is it from my side, and all the best for the rest of the year.
Thank you.
Thank you. The next question is from the line of Pranay Roop Chatterjee from BCMPL. Please go ahead.
Hi, good morning to everyone present. Am I audible?
Yes.
Yes, sir.
Yeah. So my first question is with regards to the XEV / tech agnostic portfolio, and I wanted to check three things here. Firstly, what are the products that are driving bulk of the volumes, and how does the product complexity compare with your core ICE products? That is one. Second is, how do the gross margins and contribution margins for these new products compare with your core ICE portfolio? And lastly, how did you start and go about building a competency here and actually signing clients? Because there are other ancillaries whose majority of the revenues already come from EV and tech agnostic segment, and I believe they would have a larger scale and be more cost competitive. So it's interesting how quickly you have transitioned to tech and EV. So if you could just talk about the competition and who are these competitors and how do you develop an advantage over them?
Praveen, would you like to answer?
Yeah, sure. I think a very interesting question here. How to look at the competition, how to get the orders, and how to remain up. So we have been right from the beginning talking about our capabilities into precision components. And to everybody's knowledge, EV still continues to have a lot of content out of the precision component. It's just that the component categories are changing. While we were making connecting rod, rock arms, and lot many other things for ICE engines, there are similar high precision components in the EV segment alone. So our first choice had been to pick up those parts. And what we see is that the customers, the new age as well as the established, while the established knew us pretty well, the new age customers also have realized that these are very critical parts, and we need to only pick up those suppliers who have those capabilities right from engineering to implementation of those. So we have been able to continuously pick up those kind of orders. And as we have been saying that our content per vehicle today is higher in the EVs out of similar those components as compared to what we had been getting in ICE. That is one part of it. Second is that we realized quite early that lightweighting would be very important going forward in EV in order to have a higher mileage out of the same energy source, which is battery. And we certainly had our earlier exposure into aluminum components out of our aerospace business. So we developed aluminum forging, and that's what exactly is the number two, that a lot of components are emerging and in fact are transitioning over a period of time into aluminum forging parts into this EV segment. Now, just to give you slightly more update on thing about this aluminum is that while aluminum die castings have been prevalent and in fact there had been quite a lot of capacities available in India, aluminum forging is a different thing which is having a higher strength as compared to die casting components. So therefore that is where we are into it, and that is where we see that a lot of transitioning happening, not only domestically but internationally also. So these two factors put together and our diversification and openness into getting into any other kind of precision category parts, I think has led to getting a lot of business, and that is what the customers have been appreciating. On the competition side, I would say, I think Preetham did touch upon that earlier also, that we have certain very important edges, particularly in terms of having our own engineering base and having our own machine building capabilities. These two put together and the fungibility that we have across our capex from our ICE to non-ICE businesses. I think all these put together, we certainly think that we have, and I think we have been getting benefited by that.
So in terms of margins, what you asked for in the new category of components, in fact, right from the time that from the thing that we have been mentioning, that where Sansera believes is that we have three very clear principles on which we take the business. One is it should be engineering centric, second one is it should be scalable, and third one is we look at very closely the ROC and EBITDAs to be around 20%. So that's how we try and get into these components. So I don't, while we say that we are getting into XEV components, but these are primarily precision engineered products. So these are activity based costed, and these follow the similar pattern of costing what happens in the ICE segment as well. So it would not be very different to what our current existing margins are.
Thanks a lot. That's a very detailed answer. And the second and the last thing I want to check is on the aerospace segment. You expect quite a strong pickup. So if you could just help me understand, firstly, is it largely linked to Boeing's production schedule? Is that your major client? And second is, who are your key competitors here? And how strong is the visibility on the scale up to 250 crores?
No, we work with both Boeing and Airbus through their Boeing directly, and for Boeing and Airbus through their Tier 1s and Tier 2. And our visibility, see, in aerospace industry, since the raw material ordering cycle is pretty long compared to because you need to have a visibility of almost 1 year because your ordering cycle is also 1 year. So we do have a clear visibility on, or at least we get a fairly good visibility from our customers in terms of what they want for the next full year. And also we do have certain order book, what we are working on, certain FAIs that we have been working on. So all this put together, we do see that a good amount of recovery is on the cards because we do have a fair amount of sense on what is going to be built for the next 1 year in terms of our existing business and also what components are getting into production. Now, as I say that, there is one is on commercial aerospace, but on defense also we are putting in a lot of focused effort and opportunities that are being created by Government of India in Atmanirbhar Bharat is also helping us to, getting into various sectors where now private sector is catering to. So I can't mention too much details into all those things, but then we are quite upbeat on even defense programs coming through. So overall, defense and aerospace and defense, as I said, answer to Mr. Basu's question, that we are looking at reaching that mark of 200 crores in over 2 to 3 years' time.
Great, thanks a lot. I'll join the queue. Thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, that's the last question. I now hand the conference over to the management for the closing comments.
Thank you very much for your patience and all the interest that is there. We really appreciate your interest in our business, and I'm sure that you will have many more questions, and we will be more than happy to answer any of your queries either directly or through SGA. So we would be more than happy. So all the best, and look forward for interacting with all of you in the future as well. Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, on behalf of Sansera Engineering Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you very much.